Hello, everyone. I'm your host, Andrew Johnson, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to make you, our listeners, more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in be boring, make money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
All right, so we have Vijay Viswanathan here today to talk about our Canadian equity portfolio, in particular our mid-large cap portfolio. So welcome back to the podcast, Vijay.
Happy to be here.
Vijay, you and I joined the firm back in August of 2007, so a little over 12 years ago, if you can believe that.
Everything for the firm changed because of those two hires.
Barring that, what comes to mind, actually, for you when you think back over the last 12 years, contrasting or maybe talking about evolution between then and now? And really, I'm going to open this up for you. You can take it in any direction you want to go in, whether it's the market or the portfolio or the firm itself.
Well, there's lots of things that have changed over the time that both you and I have been here at Mawer. I mean, we're a much smaller firm then. I think I joined like 2 weeks before you. So I think I was employee 46 and you were 47, something like that. And now we're well over 160 people, at least full time. And back then we had one office and now we have 3 offices. So it used to be just be in Calgary. Now we have an office in Toronto. We have an office in Singapore. So I think that has changed. We've obviously seen significant amount of growth in assets over time as well. So not even the number of people, but also assets, and had at that point, I can't remember how many asset classes we would have had, but in our time here, we've added new asset classes to offer to clients because we think we can offer them pretty decent risk-adjusted returns over the long term. So that would have changed. Thinking about Canadian equity, which has been where I've focused my time pretty much since I've been here, there's been, I'd say, considerable shifts in the investable universe. If we go back, I actually had to pull these numbers up, but I went back to Q3 2007, which I would have started in August of 2007, and pulled out and saw, okay, how many constituents were there? Do you want to guess, by the way, how many there were?
In the index?
Yeah, in the overall investable universe, so trading on the TSX.
In Canada. 450.
It was 269. So you're close. Q3 2019, I just pulled this number. What's in the index? It's 233. So there's less companies.
Oh, that was a question. That was another.
I don't know. It's like a rhetorical
Q&A?
question.
Yeah, okay.
The other piece that has changed has been the makeup. When we would have joined in Q3 2007, it was, especially if you lived in Calgary, it was definitely boom time in Calgary. I remember when I moved from Toronto to Calgary, it was very difficult to find an apartment. You go look at an apartment, you look at it, and 30 minutes later, it'd be gone. Definitely a different time here, and you've seen that with the energy sector, where it was one of the largest. It was second largest sector in Q3 2007. You've seen that drop considerably. I've seen the same thing with materials, especially within mining. You've seen that been greatly reduced when you think about the overall number of constituents, but also its weight, I guess, within the index. And a lot of where you've seen the appreciation has been industrials, driven by rails and others, as well as in financials. A lot of that driven by banks and others. So I think, and I guess technology would be the other one, which has sort of moved as well. So those are sort of some of the observations firm-wide, but then also just the overall breakdown of the investable universe. It's also been pretty good times in the markets over that period as well. So
yeah, do we get to take credit for that as well?
Sure. I think we can take credit for almost anything that happened in that time frame.
So I think the concept that gets reinforced for me hearing you talk about the shift in the investable universe is that capital really is mobile. So it can move around to different places, not only within a market, but we're global investors. So if we step even a little higher up, is Canada still a good place to be from a marketplace, from a company perspective, and really in terms of relative competitiveness around the world?
Well, it's a multifaceted question. And we think it's important as investors to be able to hold up opposable viewpoints at the same time. And so the way I'm going to answer your question is talk a little bit of what I think are the pros for Canada. So the Canada would be the sort of some bullish arguments. And then there's sort of the great Canadian short or the great white short, which would be the sort of bearish argument. So what are the positives for Canada? Well, we got rule of law. We got a stable financial system. These are things that sometimes we might take for granted as Canadians, but it is a very important thing to have in order to attract capital. Beyond that, we've made, I guess, some policy changes, which I think make sense. So we have reaped the benefits of immigration over a long period of time. I'm obviously biased on the whole immigration piece. I wouldn't be in Canada if my dad didn't come in 1966 and forever changed his life and changed the fortunes of our family. We've reaped the benefits of that as a country, and we continue to have policies in place that are pro-immigration. That can be a great driver or tailwind for the economy. And people want to live here. Those are positive things. The last one I'd bring up is that we have a lot of stuff that the world wants. We're blessed with these riches. I know the one that gets the most news in the headlines today would be energy. So oil and gas, we do have lots of that. We have potash, we have uranium. We have lots of things that the world has to offer. And so those are a lot of the reasons why you could argue, yeah, this is a good reason to invest in Canada. Beyond that, we have really good management teams. There's lots of reasons to do it. Some of the things that may be reasons why that there's some risks within Canada, and I think you alluded to a little bit around capital being mobile, is just, well, where do we stand from a comparative advantage standpoint? So we have to make sure that as a country, we continue to create an environment that wants to attract capital, because capital is mobile. And we have seen in some industries that capital has left the country, and energy would be the one that would be the most notable, where we saw a lot of, for example, drilling equipment that went from Western Canada that went into Texas, because that's where there's lots of activity. I mean, I think the one within the energy patch that would probably culminate this or magnify it the most would be the news last week of Encana moving from Canada to the U.S. I mean, Encana, Energy Canada. And now that is, well, it's not called that anymore. It's going to be domiciled in the U.S., essentially a U.S. company. Yes, it does have a Canadian workforce and Canadian assets, but for the most part, a U.S. business. That is a risk that if we don't create an environment in this country that is conducive to attracting capital, because it is mobile, it will go to other places where it can earn return. So that could be a negative potentially for Canada if we make it more difficult to do business and do business in a responsible way. So I don't know if that answers your question. Or...
Yeah, it really does. And I think it highlights just, I mean, oftentimes investors, sometimes clients, sometimes ourselves, we get narrowed into this myopic view of where we operate. And really what's happening is policy, economy, markets, businesses, they all collide at some point. They converge into what makes a great place to invest.
Well, the other thing you were seeing is we have lots of global champions, like Canadian businesses that have gone abroad. They're allocating capital abroad and building their businesses. So we do have that as well. And so, as I mentioned, I think there's lots of good reasons why people should invest in Canada.
Okay, so on a related note, I think we can just change our view to the current state of the economy here in Canada. I had to pull a few things here because we've had a pretty good streak of growth here in Canada. I think that's been driven in large part by the services part of the economy. The labor market has been on a tear. We've had unemployment somewhere in 5-6% range. Wage growth has followed that, so that's been nice to see. And not surprising, consumer spending has followed that. And it also looks like housing at least is trending towards more new homes being built. So we've got that going for us as well. All of that, at least on the surface, to me, appears to be positive for Canada. But I wanted to get your thoughts on, well, just on the economy itself, where your head's at with that, but also does it inform decisions that go into the portfolio itself?
Well, I agree with what you said. You were essentially reciting facts. you said you pulled out statistics from StatsCan. So I think, yeah, a lot of that I would agree with. That it seems like we have very low unemployment, labor market's reasonably tight. We're seeing strength in the services economy, and there's been a shift to more services. So those, I think, are positive. We've seen income growth. Housing, it seems like the government put in place some of the controls they put in place to lead, hopefully, to a softer landing seems to have worked. And we're actually seeing a resurgence in activity when it comes to loan volumes around housing. That could be a positive, although it could lead to a negative where all of a sudden now homes become unaffordable again. So And we have low interest rates, which is sort of the foundation of a lot of the asset appreciation that
can't be understated right now.
Yeah, so that's been a big driver of asset values over time. So it does paint a reasonably positive picture. And just as we've seen companies in the portfolio from an earnings standpoint, as they've released their quarterly earnings, the numbers look reasonably positive. We've seen some downticks in rails and rail volumes. So that's one where usually it might be a flashing warning sign. Although some of that, or a lot of that, seems to have to do with grain. And that just is sort of weather related. So maybe that'll fix itself as they start moving more grain volumes in Q4 and Q1 of 2020. So there may be some slowing. So we are seeing some pockets in some of the businesses where we're seeing some deterioration, I guess, in fundamentals, but still growing. So I think that's important. What we've seen is maybe slower growth, but still growing. And so definitely paints a reasonably decent picture and backdrop, at least what we're seeing. Now, how does it play into decisions? Well, we always say think micro, not macro, but the macro does matter. And at least at this point, we pay attention to what's going on in the general economy because it is important, what's going on in Canada, to our businesses. But I think what we're seeing in the businesses itself is not too much sort of stress from maybe what gets the headlines in the newspapers.
Maybe just diving a little bit deeper into looking at the portfolio overall. It's called Canadian equity, but you even touched on a little bit earlier about having global champions. I mean, how many of those do we have in the portfolio that are operating outside of Canada, earning revenues outside of Canada?
I would think that, I know 25%, last time I looked at 25% of breakdown sort of currency, so breakdown revenue by currency, still 50% of revenue is coming from 50 to 60% Canadian dollar. And the rest would be sort of split mainly US dollar and then euro would sort of make up the bulk of the rest of it. So I'd say, but most companies that are in the portfolio have businesses outside of Canada. You know, the ones that wouldn't, the telcos and the cablecos that we own are pretty much domestic businesses. All the banks, they all are allocating their cash flow to the US in most cases, or in Scotiabank's case, into parts of South America. So I'd say the majority of the names in the portfolio would have operations outside of Canada.
One of the general directions that happen in conversations, whether we're passing in the hall here in Mawer or in meetings here or in conversations with clients, is just general themes that sort of arise or emerge through the portfolio or the economy. And one of those themes, or at least one area of the market that here in Canada has proven to be a detractor of late for us, at least from a relative standpoint when we're comparing ourselves to the index, is gold companies. And we talked a little bit earlier about our history here at the firm. I think in that history, I don't think we've held any gold companies that I can recall, but maybe take our listeners through our thinking on that industry and the companies that make that industry up here in Canada. Yeah,
so we continue to revisit all names in the universe, and we have relooked at all the gold producers. At least this year we revisited our thinking and our assumptions, and we came to the same conclusion. You know, we've seen some improvement, but we came to the same conclusion we have in the past, that it just doesn't fit our investment philosophy. And we know that could be painful from at least a relative performance standpoint. But at the same time, we're going to stick to our systematic philosophy. We're going to stay disciplined on our philosophy. We're not going to chase the flavor of the month or just chase companies or an industry just because they're doing well in a given year. We're going to continue to allocate capital as we best see fit, our clients' capital, to the best risk-adjusted returns. And that has led to us avoiding gold producers. And if we continue to see those run, continue to see the gold price continue to move, gold price goes to $2,000, $2,500, gold producers will probably do reasonably well. And that's going to lead to relative underperformance. And as clients who are listening, who are invested in Canadian equity strategy, Canadian mid-large cap equity, should know that.
Okay, so one other theme that has been brought up more recently, I think this is a more recent phenomenon here in Canada. And for context for listeners, it's regarding the healthcare sector. And I wanted to give full perspective on this sector. So I'm going to recite some facts again, as we alluded to earlier. So for our listeners, there's 11 stocks that make up the healthcare sector here in Canada. 3 of them are assisted living facilities for the elderly population. So Extendicare would be a name many people are familiar with. 2 are more traditional pharmaceutical companies, and 6, so over half of the names in the sector, are in the cannabis industry. And for further context, the entire healthcare sector makes up about 2% of the total index. So Canada's already a narrow market. Healthcare is certainly a narrow sector within that market. But I think the fascination around the volatility is really around the cannabis industry right now. My story is it's for a couple of reasons. One, anytime there's potential to make a bunch of money in a short amount of time, essentially by guessing and getting lucky or speculation, that's seductive to us as humans. And the second one is that this is a nascent industry. It's unfolding and coming into its own right in front of our eyes. And that just doesn't happen very often. So it's fascinating from that standpoint too. I'd like to hear your thoughts on the industry and really whether or not these stocks, when we hold them up against our philosophy of wealth creation, strong management, attractive valuations, do they fit within our portfolio?
The short answer to your question is no, they don't fit, at least not yet. The longer answer, which I will give you, is it sort of fits into the second point you made around it being a nascent industry. And so for us, that's what we took it as an exercise. We were very open and curious around, okay, well, what is the value chain? What does the value chain look like for the cannabis industry in Canada? And my colleague, or our colleague, Mark Rutherford, is one who did most of the work, so he should get the credit. That's why I'm giving him a shout out on the pod. He knows the industry really well. He looked at the whole value chain for cannabis because we had some assumptions going in. And I think it started with, well, what was the government trying to do? And what was the government's objective when they legalized cannabis? And our story, and I think it has been backed up by the government themselves, is they wanted to essentially move sales off the black market to the legal market. And you can see how this benefits the government twofold. One is that movement, and the other is, well, they get to capture the tax dollars off of that. And that's the way that the industry has been structured. So our going in thesis was that the federal governments, provincial governments were going to make all the money in this industry. And it turns out that that's most likely the case because whether it's provincial or federal, they are essentially the middle person in this. So you have producers that are going to produce. The price that they can sell is set by the government. They're the wholesaler. And then on the distribution side, it's either the government is the distribution or it's a private entity where the price is set by the wholesaler. So we've seen something similar in other markets, and over time, prices have come down. We've seen it in Colorado and the state of Colorado, the state of Washington, where they're actually a little bit more open than what we have in Canada. But our going in thesis was that the governments were going to make the most money or economic rent from this value chain. And that's, after our work, that was corroborated. I think over time, could there be some businesses that would be investable that could make sense in cannabis? If I were to if I think about that for a moment, it's like, well, yeah, I think they are. I think that you'd want to be closer to the customer. So you might see some brands that have some sort of recognition and may be able to charge a premium for over time. But I think the base case is that this will probably be very similar to what we saw with the wine industry in Canada, where it's really the government and the provincial, the federal authorities are the ones that are making all the money. So we haven't found anything. Back to my short answer. We haven't found anything. Now, we do have companies that benefit from the build out of the cannabis industry. So Shopify is one in the portfolio where they do all the back end for all the online sales through government channels. So that's one we could reap benefits. We have Shoppers Drug Mart that we own through Loblaw, which would provide distribution, and that would be medicinal cannabis. And that would be through their pharmacies. I can drive more traffic, which can lead to you come in to pick up your prescription, and then you buy some shampoo and tomatoes and other stuff. So that's kind of where we've landed on it. There might be other ways to get exposure, but nothing directly.
I'm actually glad you brought up Loblaw because I wanted to talk about that too. It's almost like we planned this out, Vijay. Loblaw has been a name actually we've held for quite a long time. I think 10 plus years from what I can tell. And over that time, throughout that holding period, competition has picked up. It's kind of ebbed and flowed in the grocery sector. Our listeners might remember Target entering the market, picking up competition, and then subsequently leaving. Loblaws has responded by doing some operational improvements over this time frame. They've also bought Shoppers Drug Mart, as you just said. We clearly think it plays a role in the portfolio for a long time, and we think it does now because I think we currently hold it at around a 3% weight. So what's our current thinking on Loblaws? And really where I'm getting at is that they've performed quite well over the last year or so. So what's driving that?
So I think overall we start again with the business. Business is food distribution. So it's mission critical to our lives is eating. And they are the largest food retailer in Canada. So that is, we think from a business model standpoint, it's a decent business model. Now, retail can be a very, very tough business. There's really no barriers to entry. But the environment in Canada is pretty good. It's pretty much a cozy oligopoly. Now, they compete, and they compete tough with each other. But it is a reasonably decent industry structure, with Loblaw being the number one player in the market from grocery. I think what's been very positive for them, and I think I underestimated it at the time, if I'm being honest, both with myself and our listeners, when they did the transaction with Shoppers Drug Mart, I thought, well, that's a pretty good transaction. And I think if you look back at this transaction now 5 years later, it's like, wow, this was a pretty it was a game changer transaction for them, because it brought them a lot of the health and beauty offerings in Shoppers. It brought them a lot of great locations, and it's really driven, if you look at Loblaw's numbers, a lot of the growth has really been driven by the Shoppers piece, which actually grows at 1% to 2% higher than the food piece, the drug retailer part versus the food retailer part. And they've been able over time to figure out merchandising strategies to bring the two together. So it's really become this one-stop shop for all of your sort of food and then health and beauty needs and your prescription drug needs or cannabis needs, which we talked about earlier. So I think that they've done a really good job there. You mentioned operationally they've gotten a lot better. Yes, absolutely, they've gotten better. It took them a long time. I mean, it was 7 years, maybe even 10 years of working through a massive IT transformation. It was painful for the company, but they got through that. They're in a much better spot now. And they have two pieces, and then I'll get to some negatives. There's two pieces I think that are going well for them. They have a loyalty program, which I think is pretty positive for them. So PC Optimum. And then the ability to harness that data to be able to provide a better experience for customers, I think are two things that are positive. To me, the biggest wild card, I mean, competition is always going to be there. I think the biggest sort of wild card, sort of uncertainty around the industry is e-commerce, online penetration. And we just don't know yet how Canadian grocery consumers are going to consume groceries 5 years from now. Is there going to be more delivery? Is it going to be click and collect? And each company within the industry has made their best judgment on that, because that could be a real game changer for the industry if all of a sudden we move towards just everyone's getting groceries delivered to their house.
Right. And then further technological advances somewhere in between, with the cart full of groceries at like the Amazon store approach, where you can walk in, grab your stuff. It's all hooked up to a card, and then you walk out and load your car and leave. I think we're seeing that already. I think I just read something recently that one of the competitors, I think it was Sobeys, that is unfolding that in one of their stores right now.
Yep. They've licensed the technology from Ocado, and so they are, at least in the Toronto area, they want to launch home delivery. So we still don't know how that's going to play out, but that is one where I look at, well, that's an uncertainty around the industry. Once we have a better handle on what that looks like, that could lead to a whole bunch of capital expenditure that Loblaw and others in the industry are going to have to do to sort of retrofit their business, right? Because all of a sudden, if you think about it, you move towards more online delivery, or you need smaller square footage, smaller storefronts. You have all these stores, you may not need them all. That's something we're definitely on top of.
All right, well, let's move from a long time holding all the way down to one of the newer names in the portfolio. So CGI, and this would be related to some of the IT transformation that we just talked about. So CGI is based out of Montreal. They're in the IT services, IT consulting industry. What's the deal with CGI?
Well, so their business model-wise, I think it's a pretty good business. So half their business would be business process outsourcing. Essentially, think of it as outsourcing when a company or a customer would say, look, CGI, you run our IT department, and it's going to be a 3, 4, 5 year contract. So there's that part of the business. That's half their business. The other half would be people doing IT projects. And I'm sure that most of our listeners, I imagine, work at a company where they've done IT projects. And I've always said that IT projects start, they never finish. And I don't mean that in a disparaging way to IT projects. I just think there's constant needs for IT infrastructure and projects within the business. That's just the nature of all businesses and almost all industries. So that's where CGI, I think, has some pretty decent tailwinds. So IT spending, specifically around some verticals that they have some expertise in. Number one is government. Big barriers, very difficult to get on sort of government contractor lists. So that's a third of their business. They've also got big verticals in financial services and built up expertise in banking and life insurance and other financial services. So I think that's one that they've done reasonably well in. Healthcare is another one. So they've got these verticals where they have decent positions, and this is global. They've executed well, And so they've got a reasonable competitive position, but relatively small market share, which ties into the management piece, which over time they've shown to be very shrewd capital allocators, very good at running operations. And that capital allocation is important when you marry it with, look, they've got lots of opportunities to grow by acquisition, buy other IT type businesses, IT services businesses, fold them into what they're doing, improve the operations, which is what they've done historically. And valuation, in our mind, looking at it on a relative basis and within the context of the universe, Canadian universe, looked pretty reasonable. So it ticked all the boxes for us. And one that I wish that we had owned many, many, many years ago when I first looked at it, and it traded at $9.
I'm sure you've got a long list of those ideas.
Yes, absolutely.
Before we let you go, we've got Christmas coming around the corner. One of the things that I like to give as a gift is a book, and I think our listeners are always looking for book recommendations. So I wanted to ask you, whether it's a book that you read a long time ago, had a huge impact, or maybe it's one that you read more recently, what's a good book for our listeners to go out and grab for themselves or as a gift? Lots
of books to choose from, and much like most of my colleagues here more, we're all sort of avid readers, so it's always hard to pick one. One that's really short, I think it's a really good one to read, is Short History of Financial Euphoria, John Kenneth Galbraith. Short book, be able to finish it off in an hour. Just goes through different time periods of bubbles. So that was one. And then one that probably turned into a movie, but it's a great read. It's a bit long, but it's a fun read. And real life, real story is $1 Billion Whale. So it's a good one. It could be fun to read over the holidays if you want something that isn't just a financial history book.
All right. Well, great. Thanks for sharing those. And thanks for spending some time with me and the listeners today. And we'll look forward to having you back again.
No, thanks for having me. And thanks to everyone for listening.
Hey, everyone. Andrew here again. To subscribe to the Art of Boring podcast, go to Mawer.com. That's MAWER.com/podcast or wherever you download your podcasts. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Thanks for listening.